And again, thank you everyone for joining our monthly webinar series on life transitions and insurance. We'll go over a few categories that come up quite often in our conversations. But first, I'd just like to introduce everyone on the call, if you wouldn't mind just waving. I'll start with myself. I'm Justin Morrow, Certified Financial Planner, Charter Retirement Plan Counselor here in our Appella Wealth Bellevue office. And Joseph Ferreira, would you mind waving? All the way from Connecticut. Great. He's a valued member of our portfolio and analyst and paraplanning team. Taylor Cox. Hey, Taylor. And our wealth advisor in our Bellevue office. Roxy Butner. Hey, Roxy. Also in our Bellevue office. Well, thank you, everyone. So yeah, we can get on to the next slide, but then we'll get into what we're going to be covering today. And if you have any questions during the presentation, anything might come up, please just send questions via the Q&A button, and we'll make sure to get to those at the end of the presentation. But that Q&A button will be live during our whole call today. Good. So we're going to cover a couple topics. And I've had a couple of insurance-related questions just within the last 24 hours, and so it's very timely. So we're going to cover term insurance through a live case scenario here, disability insurance. Again, there's two types of really main disability insurance we think about, which is your group disability insurance through your employer, but then you can also buy supplemental disability insurance outside of your employer. And what does that mean? And then we'll also go over long-term care, which as part of a financial plan is often a big part of our financial planning conversations. So we can go on. So early life transitions, Taylor and I are going through this currently. And what does that mean for protecting your family? Both of us are recent fathers, so we thought this would be an interesting real life case example to go over. And really you're given the choice of how do you protect income replacement and protect your family? And what does that income replacement look like? And so that's what Taylor will be going over. So Taylor, please feel free to take it away.
Thank you, Justin, and thank you everyone for tuning in. I mean, there are a lot of life transitions and life experiences, we all go through, and sometimes we make good decision making and sometimes bad decision making during these experiences. For example, using your daughter's 529, budgeting for World Cup tickets, probably not good decision making. I'm not talking about myself in this instance. However, like Justin was talking about, this example, I am talking about myself since I've been a dad now a year. And I wanted to walk through, real life example with real numbers and how life insurance can be used. So here we are, right? We're looking at Joe and Emily. They're 30 years old. They've been married for 4 years. Bought a house for $400,000 about 2 years ago, and now have just become parents. So, right, they are transitioning from a combined income of $200,000 to now just Joe's income of $100,000, and Emily has stepped away from work to stay home. So the biggest question is, right, if your income stopped tomorrow, what happens to everything you just built? For Joe and Emily, that one income supports their whole life currently and even the future. So looking at their financials, right, we're looking at, their expenses, which is $3,000 a month, for the mortgage, and then $2,000 a month for their living expenses, and now new expenses for that baby that just came in. I know diapers, formula, all that's expensive, trust me. So we have around $6,000 a month there. So looking at the next slide, right, we want to see, hey, what are we looking at for quantifying the need? So we're looking at, hey, income replacement, paying off that mortgage. Some, college is also a big one there. And then for some instances, right, childcare is also a big subject, right? And then also we want to look at, the emergency fund for Joe and Emily. The retirement accounts, we put them in there, but we don't want to use those unless absolutely necessary. So put red there. And then finally, right, you want to plug in your employer life insurance. Then that brings us to the safety net. So for Joe, right, the focus is time and what do they need, right? So we're looking at 100,000 of Joe's income for 20 years. We want to pay off, right, the mortgage for Emily and the family. And then, right, the big one here is college funding. And not a lot of us, and even myself, was thinking about this when it came to life insurance, but right, we are planning on long-term goals for the family, and college funding is important to the family. Right, this number is pretty conservative with future costs of college. Right, we'll see what that looks like in 20 years from now, but we'll just keep it how it is. Then we want to minus out the emergency fund and the employer life insurance, which for them is pretty minimal. Their emergency funds are quite low because, like I said earlier, Joe spent all that on World Cup tickets. And then the employer life insurance is quite low. I mean, the average is around 1 to 10% of someone's salary. So, right, when we get to the number, right, we're looking at a total need of coverage of 2.5 million for 20 years. And my value perspective is saying, hey, right, if I'm spending $120, a month or $10 a day, and that's right, creating 2.5 million worth of right protection for my family and my kids' future, that is worth every single penny. Right, so our goal here is you're converting a small monthly cost into long-term financial certainty for your family. So that's kind of the biggest thing we wanted to focus on really was, how life insurance is, important for young families. And thank you for this fast but small example on this. And now, next part of the journey for Joe and Emily will be led by Roxana on disability.
Perfect. Thanks, Taylor. Yeah, so we're going to be shifting a little bit here to look at midlife. And I think this is one of the most overlooked and maybe arguably most financially vulnerable stage of life. Um, it's typically when everything is working really well. You're in your peak earning years, your career is established, your income is high, your 40s and 50s. Your financial plan is starting to really come together. You've got retirement planning in check, you've got college planning figured out. And at the same time, there's also the increasing health-related risk. So when things are going really well financially, there's often a sense of overconfidence, sometimes even that invincibility feeling. And so people tend to, they've got insurance on their home, they've insured their life at early life, but they don't always fully protect the thing that makes it all possible, which is their ability to earn an income. So that's what we're talking about here. We're going to be talking about protecting your earning power. So at this stage, as I mentioned before, there are four main dynamics that are happening at once. Again, you're earning the most you will ever earn. Your lifestyle is really built around that income. Your financial commitments are at their highest, and your health risks are starting to rise, even if you feel fine. So your financial life is more dependent than ever on those paychecks continuing to come in, and many people have not revisited their protection strategy since probably having a child and getting life insurance. So the question becomes, if your income stopped tomorrow, even temporarily, what happens to all of your other plans and paying those expenses? retirement expenses, college funding, your mortgage payments, all of it's tied to your ability to work. So how do you protect that? Disability insurance, it's simply income protection, as I mentioned. It replaces a portion of your income usually if you're unable to work due to an illness or injury. There's a few key types here that I want to point out. So you've got short-term disability insurance that typically covers 3 to 6 months of income. You've got your long-term disability insurance that can last years or up until retirement age, and it really protects that long-term earning power. And then you can get either of these through two different channels typically. One, as I think Justin pointed out earlier, through your employer, they often will offer some coverage, sometimes short-term, sometimes long-term, more often short-term. It's the most convenient route because when you sign up with your HR, you usually just kind of automatically enroll because it is so low cost. And it's going to cover a certain amount, like I said, 3 to 6 months, but there's oftentimes some gap there in the benefit that they will allow. And then you've got individual or private disability that you can go through and get through a private insurance company. This is more customizable, it's portable, doesn't matter where you work, which is especially important because if you do lose your job due to a disability, then your employer coverage may terminate and then it would not apply if you only have employer covered. So also one important thing to remember is most employer plans will not replace 100% of your income. As I mentioned, there is oftentimes benefit caps. So that will create a gap in income, especially for those higher earners. So it's important to go in and see what policies you have. So going back to Joe and Emily, as Taylor kind of introduced us to them, let's paint the picture here. Let's imagine Joe is in his 50s. He's at the peak of his career. He's a specialized surgeon now. He's moved up the ranks, and he's the primary income earner for his family. He's got retirement and college funding plans underway, and unfortunately, he experiences a mini stroke, and it impacts his ability to use, fine motor skills and obviously to perform surgeries. So he's been advised to step away from work for about 12 months. It's not permanent, but the financial consequences still may be significant. And one important thing to kind of note too is most disability claims are temporary, just like this, not necessarily permanent. So this scenario is a lot more common than people might expect. So let's see what Joe's existing coverage is and what kind of gap he has. So he's got his employer provided short-term disability plan. It covers about 3 months of his income. And then after that, the income will stop. So his expenses won't. So he'll have another 9 months of expenses that he needs to fund. He begins drawing from savings to start. He has to pause his retirement contributions, and he might need to tap into his investment accounts. But it looks like he'll be okay to fund the gap. This is what we called being able to self-insure. Although, this health event was temporary, as I mentioned before, the financial impact can be long-standing and really put a bit of a damper in your retirement planning and even college planning, depending on at what age something like this might happen. So how do you protect yourself? The steps that I would follow, number one, understand your employer coverage and its limits. So often we just sign up, but we don't actually have any idea what the details of our coverage is or are. So pull up those policies and look at the details, figure out what you have. Then you can look at your ability to self-insure. So work with your financial planner and find out what your options are to self-insure in case of lost income. Especially important if you are the primary income earner, and especially important if you are a higher income earner. You can look at options for, do you have enough in savings in your emergency fund? And do you have enough in your investments? And where are those investments? Because if you're under a certain age, retirement accounts, for example, you may be looking at penalties to take money out of those. So have those conversations with your financial planner. And then if you need to, you can look at layering in some individual or private long-term disability coverage, which would sort of fill in that gap where you cannot self-insure. And it's important to also make sure that you're thinking about your specific occupation risk. Obviously, with a surgeon, like in Joe's case, his stroke affected his ability to work for quite some time. You have to look at your situation as well and what kind of coverage you have there. And so that was looking at Joe's kind of midlife. We're going to pass the torch over to Joseph, and he's going to talk a little bit about end of life and long-term care planning.
Thank you, Roxy. That was great. So now let's evaluate a major life transition which would affect Mr. and Mrs. Smith in the form of long-term care. So first, I want to define, oh, yes, we actually have a polling question. Do you have long-term care insurance? So the majority of people is no, but interestingly, of those who participated, we do have some. So interesting. With long-term care, let's first explain what it is. So what you see on your screen is the definition of long-term care per the New York State Insurance Department. And ultimately, what we can gather from this first bullet point is a corrective misconception regarding long-term care, and that it's synonymous with nursing home care. This isn't the case. Long-term care and the assistance for it includes a broad range of services. And to dive into what would qualify someone for long-term care assistance from a physical perspective, it would be the inability to perform 2 of 6 activities of daily living for at least 90 days. These activities would consist of bathing yourself, eating, dressing, controlling bowel movements, being able to get on and off the toilet, getting out of your bed, out of your car, or a mental impairment to where you're at a state in your life where you just cannot be left alone at house. So we can see the impact regarding this sort of event to someone individually, right? We often don't want to think of ourselves potentially being in this state, but with what I just said, it's quite scary to think about. So not only does this affect yourself, but if we want to look at also the second sentence in the second bullet point, when it comes to the type of care we can receive for a long-term health event, well, it could be in the form of formal assistance through maybe in-house care. We're at a nursing home facility, or now importantly, informal care, potentially your spouse, children. So now this is beginning to encompass and now beginning to affect your family. So of course, this is why we want to talk about and address long-term care planning. So coinciding the definition of long-term care, it's important to understand the reality, but also the high cost associated with this event. So as we could see from the first fact, right, 70% chance someone 65 or older will need long-term care services. It's something that you think won't happen to yourself. We may be physically fit now or mentally intact, but I'm sure we've undergone maybe someone in our lives where they need assistance, whether we have to informally provide it or we have the means to take care of them. It's more common than not, and it's something that we need to look in the mirror, so to say. And now when we discuss the costs, as you know, in 2019, the national median cost for nursing home care was $102,000. The figure as of 2024 was 111 and change. It's less pretty, but we can see how really how egregious these costs are, and ultimately the potential reality of them. Um, the last bullet point, the national 5-year average of inflation is 3.11%. And quite honestly, within recent years, if we want to dive into more skilled care and more expensive components of long-term care, these costs have actually increased by 7 to 10%. And to put this into perspective, right, inflation's commonly in the news. Uh, the 30-year average of the CPI, or Consumer Price Index, is at 2.49%. So the high costs are evident in the growth at which those costs is only supporting. So to summarize these first two slides we reviewed, it's impacting yourself gravely, your family, but now we can see the potential impact, of course, to your financial legacy. So let's transition into how we can support ourselves. And I want to first shed light on this pie chart, as this reflects the funding sources for long-term care in 2020. And the value of this total pie is $361.6 billion. So yes, just north of $200 billion of long-term care funding came from Medicaid. What do we associate Medicaid with? A lack of assets. We've spent down our assets, and in this case, if we've spent down assets, there's a 5-year look back when applying for Medicaid. But a common misconception regarding long-term care funding is Medicare. And Medicare does not pay for custodial nursing care if that is the only care needed. Medicare will cover up to 100 days in a skilled nursing facility per benefit period, but you need to be hospitalized for at least 3 days. So now we need to talk about, well, I have assets left. I don't qualify for Medicaid. How am I funding for this care, for the extent of these services? Well, we have the first list of options, which would be self-funding. And similarly to a disability analysis event, we need to see if we're capable to self-insure, and this is if this is ideal with our financial plan. So to self-fund, a few options may be taxable assets. To Taylor's point, regarding more an earlier stage in your life, maybe you and your spouse had established joints with rights of survivorship, right, throughout estate planning. Maybe we still have assets there. Transitioning now to retirement assets, right? Those tax-deferred assets are, right, they're taxable at ordinary income, but if medical expenses are 7.5% of your adjusted gross income, we know we can itemize those expenses. Roth assets, right? Kind of this golden goose you've maybe heard from your advisor or read. Again, these assets grow tax-free. They're not subjected to required minimum distributions. So potentially, and you may have done this as well in those low tax bracket years, if they make sense, right? If we could execute some Roth conversions. And then rounding out some self-funding options, you could have a health savings account, as well as a common source, lastly, tapping into the equity in your home. But if there are potential other options to assist in funding this egregious care. So let's move into some insurance options. And the reason why we asked the polling question of who here has long-term care insurance, well, 3 to 4% of Americans age 50 and older have standalone long-term care insurance. So why is this the case when we've seen the expense impact of such an event? Well, maybe you've personally undergone it, or you've heard or read kind of those horror stories regarding owning and trying to use long-term care insurance, somewhat the difficulty in getting those benefits and applying those benefits, but even more so, right, those horror stories regarding premium jumps. As we age and get older, just unexplainable costs to, or unjustifiable costs regarding long-term care insurance that make owning the policy seem difficult. So, what can we exactly look for to maybe make a long-term care policy more reputable? First and foremost, regarding any insurance we're shopping, we want to make sure we're looking at reputable insurance carriers, but also some means that may help maybe our total policy premium, managing reasonable benefit periods. So how long we receive long-term care assistance. We may not need lifetime benefits, a 2-year benefit period, a 3-year. Only 25% of long-term care scenarios, these events, the person receives benefit past 4 years, right? In part, probably to old age. And so again, there's 5-year benefit periods as well, but lifetime benefits may not be necessary. And then looking at it, elimination periods, maybe that's when the policy kicks in. So 0 days to 30 or 90. But other things we want to really look at to make our policy worthwhile, as well as, inflationary riders, looking at compound riders. And also, though, there's other riders that may make sense, in-house care. You really want to, regarding insurance, everything is its own contract, its own case study. So being very adamant in doing research into your policy. And then regarding when to apply for long-term care, there's cheaper rates in your 50s compared to 60s and effectively later. Interestingly enough, there's roughly a 0.25% chance of denial when applying in your 60s compared to closer to 50% denial in your 70s. So to quickly touch on hybrid life insurance, this is contradicting to long-term care, in which it eliminates that use it or lose it provision if we were to now undergo a long-term care scenario. So really just differentiating between linked benefit long-term care and a permanent life insurance with long-term care rider. The linked benefit, it's going to utilize, combines both a death benefit as well as long-term care assistance. It's going to use the death benefit first, and then those long-term care pooled funds. There may be a minimum death benefit within the policy. And this slightly differs just from a permanent life insurance policy with a long-term care rider, in that it's either one or the other. If you were to pass, you receive the life insurance. If not, it would reduce your life insurance benefit, the death benefit, dollar for dollar. And then to round out kind of our insurance and annuity options, to provide potential assistance regarding long-term care. There may be annuities with long-term care riders. Again, being very careful with where you're shopping, understanding the types of riders associated with the policy and how much they cost. But a potential example of what this could be is, say your annuity pays out $100,000 a year. You may receive a total benefit now, or a payment of $200,000. Regarding a qualified longevity annuity contract, this does not necessarily directly help offset long-term care costs. It more so help with, potential general costs in your life, but it can, of course, support, right, long-term care assistance. And what this is, as of 2026, you can defer $210,000 of qualified pre-tax assets. And so they would not be subject to required minimum distributions. And effectively, you can delay that money until you're 85 years old and then receive an annuity payment, right? So the greater delay, the greater the payment. whether the popularity of this is unsure, these are just some of the options available to us at a high level. Of course, if you want to dive into something like this, you speak with your advisor. But to round out maybe evaluating insurance, it may not be intended to cover the entirety of a long-term care cost. There may be already saved assets, but the direct hit in the financial consequences, similarly to Roxy discussing long-term disability, right? There is that grave economic impact, and of course, these are the potential options at our discretion. So I'll kick it back to Roxy to round out.
Thanks so much, Joseph. That was awesome. Yeah, so looked at, in this case, Joe had not made it to his long-term care event, so we didn't really use him in the example, but just following someone's life, insurance can be important at all different stages of life. And as in this case, Joe's life changed, his risks changed as well. And so the role of insurance, it's not there to predict the future. It's there to make sure that your life transitions don't absolutely derail it. So that's kind of our big takeaway for our presentation today. And we thank everyone for being here and for listening. And I think we can open it up to questions now. And let's see if I can even see where the questions would be. Okay. Okay, let's see what we're working with here. So, okay. Let's see. Got a few here. With long-term care being so expensive, when should we realistically be looking at buying long-term care policies? And I think, Joseph, you kind of touched on this. You said over 60 or 70, it becomes pretty difficult to get even approved, right?
Yes, I think really probably the ideal time would be looking at even shopping a policy in your 50s, even though we do discuss that this is kind of the end of a life event, but potentially in your early 60s as well. Really, though, as you get older, it does become a lot tougher to qualify for the policy, and then also the enhanced premiums as well.
Yeah, I agree. I think 40s and 50s is probably the most common point where people look at a long-term care policy. Because if you get it too early, then you're paying for such a long time. If you get it too late, then you may not be approved. But I think going back to everything that Joseph said is what's more important is making sure that you are accounting it at least in some way in your financial plan. So working with your planner to see if this happens. Most folks, I feel like when I talk to them, they use the equity in their house and that they consider that their long-term care plan, but like you should actually run the numbers and see if that works out. So talking to your financial planner. Let's see, are there any other
And
questions?
I'll just add one other thing too. This has come up recently with folks I work with, is if you've built up some cash value and a cash value life insurance policy, working with your wealth advisor to look at different exchange options to see if you can take that cash value if it's not meeting your current needs, because life transitions happen. And there are cash value life insurance policies that have a long-term care rider. And in this higher interest rate environment we've been in, it can be something to consider within your plan. So talk to your wealth advisor and about your cash value insurance in relation to long-term care as well.
Thanks for that, Justin. Let's see here. We've got, what are the most important components to the long-term care insurance since lifetime coverage is no longer standard? Anybody want to chime in and take this, or I can touch on it? So I think,
I just curious what you'd say, Roxy, as well, but I think really right, inflationary rider the compounding inflationary rider, as we saw how fast and how aggressive those long-term care costs grow. But
Yeah.
that's
And
what-
also, obviously, the daily benefit that they're projecting, and as Joseph went through in his presentation, how long that coverage will last is really important. We've had folks who I've worked with who they think they're good because they have a long-term care rider on their annuity. We find out it covers basically next to nothing compared to what the cost would be. So making sure you look at those. Justin, was there something you wanted to add?
I would say look at your exclusion period, how long before your insurance company will cover you. What are the requirements? Are there maybe 2 of the 6 activities of daily living that you cannot do, which would allow you to then qualify for the policy? And then what is your total benefit amount? Is it 200,000, 400,000, 600,000? And then planning around your other assets, how long the long-term care would last.
We've got how is the pricing comparability of long-term care versus hybrid life with long-term care optionality?
Yeah, so combining both benefits of life insurance with long-term care, you're on average, it's going to be maybe 2 to 4 times more expensive than just long-term care.
Let's see. Washington State established a long-term care plan, which the concept was good, but the implementation was troubled and the law was rewritten. The long-term care industry was disrupted by these changes. Has the situation become any more clear for those of us who live in Washington State? So yeah, what they're referring to is they implemented sort of a mandatory long-term care, but I think the max lifetime benefit is something like $36,000. So and they're requiring a certain withholding off of your paychecks to pay for that. So it basically, I mean, realistically, it doesn't have much of an impact on if you actually needed long-term care, it's not really going to help or go very far. Let's see. Someone said Joe died. Have you heard about continuing care retirement communities taking one's long-term care as part of the buy-in for retirement residents in one of these continuing care retirement communities? The ones near me in DC are doing that. Yeah, I mean, I'm sure there's all sorts of different arrangements across the nation when it comes to senior living facilities and the buy-ins and the costs associated with all of them. So it doesn't surprise me. Let's see, did I miss any here? I think that's it. Was there anything anyone else wanted to add? Give a couple more minutes here.
Justin here, I would just say if you have some type of life insurance policy, especially cash value policies, spend the time with your wealth advisor to look at that policy. We have a lot of good partnerships where we can go to the open market and make sure that it's the best policy for you. It's a really good opportunity to look at these type of questions we're discussing today in action.
Yeah. Thanks, Justin, for that. Well, I don't see any more, so I think we'll go ahead and, oh, I just got one more. Would you recommend a cash insurance policy over regular life insurance?
I mean,
It
I think
depends
it,
on,
yeah, go ahead, Justin.
well, Taylor, did you, I'll ask you the question. I'm the audience member now. Did you buy term or cash value life insurance to cover income replacement
I bought
for your
term,
family?
absolutely. So
Yeah. I did
But yeah,
too.
yeah, go ahead. I
Yeah.
mean, you can go over your reasoning if you want. So,
Just just to kind of step back, we were just talking about the Washington CARES Act, which is a, a, a payroll tax effectively. And so in 2021, you had a deadline in order to get a cash value life insurance policy in order to not pay this payroll tax. So when I look at my statement, the percentage of because I still have to contribute to that monthly, the expense ratios, you mean the mortality and administrative cost of that cash value insurance policy, they're high enough that it's just something I'm doing to avoid the payroll tax, not in order to make an investment in my family's future. So I think within our office, what we sign is buy term, invest the rest. Term is just lower cost. There are some downsides, of course, that cash value that you're paying in, it's not going toward something. If you don't meet, if you live, then it's a sunk cost. But on the other side, the internal operating expense of certain cash value life policies can also be a sunk cost. So again, something to run with your wealth advisor, pros and cons to see what works best for your plan.
Yeah. Again, life insurance is there as protection against, either death, disability, income loss, or a health event, not so much as sort of a means to improving your financial plan. Okay. Let's see. I think that's it from everyone. So we thank you guys for joining us today. If you have any further questions, reach out to your advisor, or if you are not an Apella client, feel free to reach out to us via our website. And we wish everyone a wonderful day.